Good day, and welcome to the DoubleLine Infrastructure webcast. Today's conference is being recorded. At this time, I'd like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead.
Well, thank you, and good afternoon, and welcome to the DoubleLine Funds webcast with Hsu and Damien Contes. Title of today's webcast, Hard Assets for Hard Times. Today, Mr. Hsu and Mr. Contes will be discussing the DoubleLine Infrastructure Income Fund, ticker BILDX, BILDX. The fund has two share classes, a retail end share class and an institutional share class. Here you can see the different expense ratios and minimums. Standardized performance on the DoubleLine Infrastructure Income Fund. The fund was launched a little over 6 years ago on April 1st of 2016. Through the second quarter of this year, an annualized return of 1.8% for the institutional share class versus the Bloomberg US Ag at 1.01%. So an annualized outperformance of 79 basis points. Some housekeeping items. The webcast schedule for the rest of the year is available on doublelinefunds.com, but two webcasts coming up. We have Jeffrey Gunlock and Andrew Hsu on September 15th to discuss the total return bond fund, and then on October 11th, our Deputy CIO, Jeffrey Sherman, the asset allocation webcast, where he'll be discussing three funds with low duration, fixed income, core fixed income, and flexible income funds. If you'd like to receive the presentation slides, you can go to the player and click on Request Webcast Content tab. You can follow us at our Twitter handle at DLineFunds, and we do have a couple of YouTube channels, DoubleLine Funds and DoubleLine Capital. Lastly, on the thought leadership front, speaking of our YouTube channels, we do have a geopolitical roundtable led by Bill Campbell, Valerie Ho, and Jeffrey Sherman. Then also we have our very own Ken Shinoda with Channel 11. So go to our YouTube channels to view those or listen to those. And then we have two webcasts, the Sherman Show podcast, widely acclaimed, and the Monday Morning Minutes with Sam Lau and Jeff Mayberry. Both of those are available on doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. So without further delay, I'll turn the webcast over to Andrew Hsu.
Thanks a lot, Ron. So when we were coming up with a title for this webcast, we were looking at the economic landscape and then looked at infrastructure sectors through cycles. And we did reflect that challenging economic environments are truly when infrastructure assets really shine. Now, COVID was impactful in a way like no other recession has ever impacted infrastructure. Obviously, global societies, they can't shut down for long, and soon enough, with the spark of human activity, this led to a strong rebound in growth and correspondingly with utilization rates in infrastructure assets. Now, we're facing new macroeconomic challenges today, but we're also confident that infrastructure will fare well. And in many ways, new opportunities will be born from some of these challenges. Next slide, please. So here, we're laying out some of the key issues concerning investors today. And while some of these do pose challenges to the macro markets, the characteristics of infrastructure assets, they may dampen some of these risks and, again, could even provide some new opportunities. First off, on the top left, geopolitical issues. They have put strains on food stability, data safety, energy security. And this puts increased reliance on our existing infrastructure. We do see CapEx growth in energy infrastructure as key for national security. And then moving to the right here, the Fed is meeting tomorrow, and the expectation is for a 75 basis point rate hike. Tackling high inflation is the number one agenda item for central banks globally. And while higher inflation has eroded everyday spending power, increases in commodity prices make it even more viable for infrastructure projects that break ground, and in some cases even be more profitable. Efforts to stem inflation do lead to concerns about hard landing or even a recession. And here, this is where the inelastic demand for infrastructure assets will prove helpful in mitigating some of the impacts of slowing economy. We do see hard assets as a defensive investment during these hard times. Finally, with climate change, this has been something that's been brought up by many of our investors and has been certainly a hot topic in the broader investment community. But the adoption of ESG standards are indicating investors are keen to support companies that are making an effort to curb their carbon footprints, and also putting a focus on other issues such as social and governance standards. Now, this has driven dollars into areas such as clean energy, and we do see this as a continuing incentive to build out renewable energy into the future. Next slide. So we did talk about energy security. This is a focus for every country. And here we're seeing global oil inventories last year, and we're comparing them to 2022. Lack of adequate capex has put producers in a compromising position to meet the spike in demand post-COVID. And this is causing a draw on reserves. Geopolitics, they're further exacerbating some of the issues here. And European nations are returning to coal just to meet energy demands. And countries like the United States are exporting more energy to help bridge the supply void. What we're seeing is the creation of an entirely new energy system. And this would reduce the dependency on traditional suppliers such as Russia, and then also increase uptake from countries like the United States that have transitioned into net energy exporters. The result would be pretty significant infrastructure spend, but we do see it as ultimately creating more resilient energy supply source, and eventually this will reduce costs to the end consumer, both domestically here in the U.S. and abroad. Next slide, please. Next, we're taking a look at natural gas storage in Germany, and this is really a proxy of what reserves look like across Europe. There are really two takeaways from this chart. Firstly, if you look at the blue line, this represents 2022. The absolute level, it doesn't look extremely low, especially when you compare it to some of the previous years. What's important to understand here is that in years where reserves were lower, the power mix relied much less on natural gas, and there were alternatives such as coal or nuclear sources. And this is really in the case of 2017 and 2018. In 2021, we did see massive demand in the wake of the COVID doldrums, or coming out of the COVID doldrums, and this drew heavily on reserves. Now, 2022 is slightly different in that we see lower levels, but it's a much larger problem now, given that Europe's power mix is heavily reliant on natural gas. So the second takeaway is what we're seeing in the second quarter of this year. Europe has started to build reserves, and they've started mandating power conservation, but also increasingly imported LNG from the United States. This has been really taxing on the existing infrastructure, and we are seeing very high utilization rates, and it's critical that we make sure that this infrastructure stays online and operational, because the number one priority right now is to get through winter. Europe needs to increase reserves to get through winter, but we do think that post-winter, this existing infrastructure will be heavily relied upon, and new infrastructure will have to be built to support some of these new energy systems. Next slide, please. Self-sufficiency, it's become the main goal for many countries. And in the area of energy security, renewable energy has become the tool to help countries take steps to achieve this. Now, what we see here, there are two bar charts. The first bar chart on the top shows the power mix in the European Union, and it shows LNG diversification as being the immediate priority. This means shifting away from traditional sources to new suppliers for natural gas. This requires significant infrastructure spend both here in the United States and in Europe to ensure storage, transmission, distribution, and other facilities to transport these hydrocarbons and to make sure they get utilized efficiently. Now, over the longer term, this is referencing the lower bar chart now. Renewable energy will be the key source to make this happen. And again, this will require tremendous investment in infrastructure, and we do see this as a very large opportunity for further build out in renewable capacity on a go-forward basis. Next slide, please. To graphically quantify what's happening in the energy space, here we see U.S. LNG exports to various regions. China's economy is still idling due to COVID lockdowns. So excess natural gas that was being shipped to them previously is now being shipped to Europe to address their shortfall due to Russia's curbing of nat gas exports. Now, if you compare this to previous years, the growth in nat gas exports is double what it has historically been. And this is expected to double again within the next 6 years. So the U.S. has very much moved from a gas importer or energy importer to very much a gas exporter. And I think this will continue to be the case, further increasing the need for infrastructure build out and increasing the use of existing infrastructure in this space. Next slide, please. Okay, clearly with energy security, this is paramount globally, and we do see CapEx trends in the past and into the future on this chart. Within traditional fossil fuel energy, there's going to be continued CapEx spend. We can't rely on renewables solely. And with underinvestment really since 2017, we do have some catch up to do. And we can see that this is producing some significant opportunities across various forms of hydrocarbons in the future. Now, for the fund, our focus has largely been around natural gas, as we've seen billions of dollars of private dollars actually flowing into projects that aim to put the U.S. in a position to be the largest producer and also exporter of LNG in the future. We have several positions in the portfolio already, and these all benefit from long-term contracts, and they are offtake. Their offtakes are with investment-grade rated or state-sponsored companies. So exceptionally secure and very stable cash flows, very attractive investments in our opinion. Next slide, please. Shifting gears and looking at the transport sectors, here we see shipping volumes over time, and what's going to be surprising to many of the listeners are that port congestion is worse now than it is during COVID. So you can see this on this chart. Disruption in supply chains, they've driven prices higher, they extended delivery timelines. This is all inflationary. So immediately, if you look at infrastructure assets in the space, they are performing well. You're seeing high utilization rates, you're seeing higher lease rates, and these are all passed through to the end consumer. Over the longer term, we do view it as critically important that additional projects are taken to modernize port efficiency. Clearly, what we saw during COVID was damaging to the overall economy, and we're still facing these issues today with very high inflation. But we do think that increased or improved infrastructure will help alleviate pressures on a go-forward basis. Next slide, please. So infrastructure does tend to have strong performance even during periods of economic slowdown. But with this chart, you can see that transport infrastructure, it was severely impacted during COVID. As manufacturing shut down during the initial outbreak, supply chains essentially all seized up. Now, if we look at the blue line, we do see rail traffic fall sharply during the first quarter of 2020. But it quickly turned around and rebounded back to normalized levels. Now, rail infrastructure delivers everything from durable goods to food to energy. And despite the brief but very severe drawdown, we are seeing volumes come back steadily. Rail assets are also found in our portfolio. They happen to be actually one of the best performing assets in the portfolio year to date. And again, very critical here in terms of a well-functioning economy. So you do see things bouncing back very quickly. Next slide, please. So another area of transport that displayed a similar pattern is aviation. Global lockdowns, as they took place in 2020, passenger revenue fell substantially. But if you look at 2022, we can see revenues approach pre-COVID levels. We've already talked about this, but the environment is definitely facing some elevated inflation. And aviation mobility figures have been very strong despite this. And they do seem to support the notion that infrastructure assets have some elements of inelastic demand. So here you see passenger revenues bounce right back up, and cargo revenues are starting to actually steadily increase as you continue to see congestion in the port. So very strong performance on the aviation side, and clearly inelastic demand, even as higher prices are in place, you see mobility numbers up. Next slide, please. Okay, back on the topic of energy security, but really kind of maybe a different derivative of it. There's been a strong push to establish energy security while doing so in a sustainable manner. So it's become much easier to do this as technology advances, and you're starting to see wider adoption of renewables and making it renewable energy more efficient and even cheaper to produce. So on this slide here, what we're looking at is the levelized cost of electricity between various forms of power over time. And we can see that the cost of wind and solar power have fallen sharply, and it's making it a lot more cost effective than nuclear and coal. But this is pretty interesting, is that it's also cheaper than natural gas, which is the predominant source of power today. What's important to note here is that the chart does not give credit to tax incentives or subsidies. So without any of these artificial support measures, renewables are still competitive compared to traditional means of power. We really focus on this area, and And, we've seen about 70% growth in this industry over the last 5 years, and it's become a lot more pronounced portion of our portfolio. We've been able to deploy capital both in residential and utility scale renewable investments. And we like these for their stable cash flow streams, but also their downside protection, given they are delivering a critical service. Throughout COVID, you really did not see any slowdown within this space, really just demonstrating the resiliency here. Next slide, please. Okay, this is the final slide for me, but on this chart, what we're comparing here is the power mix in the U.S. between two time periods, 2010 and 2011. With the shale revolution and more recent focus towards cleaner power, we've seen coal-fired power drop by more than half, while natural gas and renewables have filled that void. As technology improves, renewables are getting cheaper, and if you couple this with battery storage, we now have renewables as around-the-clock power source. So we do see a number of exciting opportunities within the infrastructure space. We do see it as very defensive with many attributes that prove to be inelastic and resilient during crises. So we do believe that also these become more compelling as we navigate these latest business cycles. With this, I'm going to pass it over to Damien to talk about some of the merits of infrastructure and then specifically about what we've been doing in the fund and the outlook going forward. Damien?
Yeah. Thanks, Andrew. Investor interest has increased in our space, and I wanted to start this section by sharing a brief overview of the evolution of the debt issuance by sector and to show the increased diversification that we have witnessed in the past few years. The asset class has been maturing, and it is an interesting concept because you will not think as infrastructure as evolving. After all, infrastructure is defined as the basic equipment and structure that are needed for a country to function properly. So you will not expect much of a change in the industry there. But we have been highlighting in our past few webcasts, we have seen a lot of opportunity in the renewable, telecom, and energy space. And it is not surprising to see that this sector have been major issuers of debt. And between 2010 and 2020, the share of issuance of debt in transportation has shrunk by 23% to the benefit of energy, telecom, and renewable, which are all opportunities. Now, the next slide, I will talk about the infrastructure debt benefits. Moody's has been compiling and analyzing this data for the past 35 years, and the results have been quite compelling. On this slide in particular, you can see that infrastructure debt exhibits lower historical default rates than their corporate counterparts. The cumulative default rates over a 10-year period for BBB assets is 3.1% for corporate debt, and it's only 2% for infrastructure debt. This delta is even more pronounced for BB assets, with infrastructure debt defaulting at half the pace of corporate debt. And let's take a step back and think about these lower default rates. Why is that? Well, for one, we know that infrastructure assets tend to be monopolistic in nature, with high barrier to entry. Think about an airport, a port, or a transmission line. It's not really replicable within a closed location. So for that reason alone, we understand the importance and the value of this asset. The other interesting attribute is that they usually also provide an essential service. And those services are not discretionary in nature. And therefore, they tend to have an inelastic demand. Think about your power, your water, sewer. They are not really replaceable, and you cannot really live without it. So I do think the strategic nature and the essential services that this asset class provides are the main driver that explain the lower historical default rates. Now, another benefit of infrastructure debt, it's higher historical recovery rates. As you can see on this slide, at the senior secured level, infrastructure debt investors are expected to recoup 68% of their principal in an event of default, versus only 55% for corporate debt. This better recovery rate is partly explained by the attribute that we just discussed, but also I think those assets are valuable because of their stable cash flows. Indeed, infrastructure assets are usually long-term in nature, and therefore they are tied to long-term contracts. Those cash flows, they tend to be heavily covenanted, which help creditors to raise the alarm early if credit metrics weaken. On the flip side, corporate debt covenants have been deteriorating in the past few years. For me, it's not a surprise that infrastructure assets command such a high multiple. Given the predictability and the length of their cash flows, this higher valuation is probably what explains the better historical recovery rates. Another benefit of infrastructure debt is its lower rating volatility, which means that over the investment period, infrastructure debt is less likely to be downgraded or upgraded. Basically, it is more stable and less susceptible to business cycles, which can be inferred by its lower correlation to other asset classes. I also think that lower rating volatility can be explained by those long-term contracts we just talked about. If you have more certainty in your future cash flows because they are contracted or regulated and benefit from CPI escalator, basically they are inflation hedged, you should not only command a higher multiple, but also your rating volatility should be less. And as we look forward into next year, we believe those infrastructure debt benefits should mitigate some of the macro headwinds that Andrew talked about. And last point I'd like to make on the benefit of infrastructure debt is its countercyclical nature. This is because government, they tend to spend more on infrastructure as growth slows down, which potentially can support investment, investment in a downturn. So let's briefly look at performance. And when it comes to performance, it is a full sweep. You can see that Buildex outperformed the benchmark in all of the period, 2Q22, year to date, 1 year, 3 year, 5 year, and since inception. Year to date, as of June 30th, Buildex outperformed the US Ag by 127 basis points, which was mostly driven by our lower duration during the Treasury rally and our sensible sector positioning. And since inception, Buildex outperformed the US Ag by 79 basis points. We also carry a healthy SEC 30-day yield of 3.52%. And during the first half of the year, we have seen our structured product buckets outperform our corporate and EM buckets. This outperformance in our structured products was partly attributable to our oil and gas exposure. And in order to gain exposure to that specific sector, we have been involved in the PDP securitization space, which basically are pools of hydrocarbon reserve that are securitized. They are structured with hedges in place to limit some commodity price exposure. And PDP here just characterize those reserves as proved, developed, and producing. Also, our aviation and our data center exposure in the structured product space was beneficial to the performance. Our Sharpe ratio, which looks at our performance adjusted to risk, is slightly better than the index at 0.29 versus 0.03 for the index. And this is a testament of the strength of this portfolio. Despite utilization coming to a halt during COVID, the rebound was quite spectacular. We are going to discuss our duration positioning here. And as a reminder, duration is a measure of price sensitivity to the change in interest rates. The shorter your duration is, the less exposed you are to interest rates changes. Our duration has been consistently shorter than the benchmark. As of June 30th, 2022, we are running the fund at 3.2 year versus 6.4 year for the benchmark, which is basically half of the benchmark of it's half of the benchmark duration. And you can see that despite interest rate volatility, we maintain a duration of about 4 years versus 6 years for the benchmark. And we even shorten more the duration as interest rates increase in the first half of 2022. We intend to keep our duration range bound between 3 and 4 years for now. So we'll have some more cushion against interest rate volatility going forward. Sorry. In addition to the increase in the assets diversity that I spoke about earlier, we have also witnessed an increase in more innovative means of financing, such as the development of infrastructure-related asset-backed securities, ABS, right? And you can see from that pie chart that we do combine those various asset classes to obtain an optimal mix that enhances yield and limits duration, as we discussed earlier. Currently, 52% of the portfolio is in structured products, and those are asset-backed securities, which are securitized by a pool of assets. Think of cell towers, aircraft, data center, solar panels. They tend to be shorter as they amortize throughout their life, and they carry a slight yield premium due to the complexity associated with their structure. And these buckets allows us to access interesting opportunity, and some of them are uniquely accessible through the ABS market. 30% of the portfolio is in infrastructure corporate bonds. This is the more traditional way to gain exposure to the various infrastructure debt sectors. We usually face a corporate entity here, and despite being investment grade rated, it is often done on an unsecured basis. We tend to favor integrated utilities here, but we also have exposure to the big telecom names, such as AT&T, for example. And 5% of the portfolio is in project bonds. This is a slightly more specialized sector of infrastructure. Here the bonds tend to be long and are done on a fully secured basis. On the table above, you can see that our weighted average life is shorter by almost 4 years, and our average price is cheaper by about $1. And despite having a shorter duration, we still outyield the benchmark by 161 basis points. Again, we're pretty unique in our space, as we have no exposure to peripheral infrastructure or to construction risk. We are exposed to the operator or the asset itself. The title of this presentation is Hard Assets for Hard Times. And on these slides, we want to highlight not only the quality of the portfolio in terms of rating, but also our focus on the collateralized asset portion. Including cash, about 2/3 of our portfolio is secured, and 1/3 is insecure, which gives us some protection to the downside. And as far as rating, we are running an investment-grade portfolio that is heavily skewed towards single A. We have been adding a small amount to our high-yield bucket, especially during the COVID market dislocation. Those trades worked well and have been pretty accretive to the portfolio, and we are still pretty comfortable with this position. Now, as a quick reminder, we are a 40 Act fund, so we invest in very liquid bonds that are US dollar denominated. And as far as exposure, you can see on that pie chart that transportation is our biggest sector. 15% of the portfolio is in aviation, where we have seen a big rebound post-COVID and continue to see positive growth momentum. 9% of the portfolio is in maritime shipping, which has been a resilient sector and has benefited from port congestion, like Andrew mentioned. And this is very supportive of overall container demand and lease rates in general. We also have exposure to railroads, port, and airports. And these sectors are quite robust and have shown stability over the years. Now, on the telco side, 12% of the portfolio is in data centers, basically digital storage, right? This has grown tremendously in the past few years, and it's really on the back of data consumption and increased internet traffic. We don't see this trend slowing down anytime soon, especially after the habit forming of working from home. Our renewable exposure is mostly solar, where we see high growth potential as the level of adoption is still rising. Additionally, we see the battery sector expanding, and we should start seeing even more utility level solar expansion. It's definitely a sector to watch. A power exposure is either in fully regulated utility or is in transmission and distribution, which are federally regulated. We have no merchant power exposure whatsoever. On the energy side, Roughly 9% of the portfolio is in midstream contracted assets, which tend to be somewhat isolated from the commodity cycles. The remaining is a mix of PDP securitization and some downstream assets. Now, if you look at the table on the right, let's look at the country exposure. We are 86% USA, including the cash. 8% is in developed countries such as Australia and Canada, and 6% is emerging markets. All the emerging market countries that we are involved in have solid rules of laws, and these are large and visible projects that are linked to the sovereign government. Think about metro station or transmission lines, for example. And we are not present in Europe as the currency is an issue. They usually issue debt in euro, and obviously we are US dollar denominated fund. Our goal is to provide an optimal risk-adjusted return while focusing on capital preservation and mitigating business cycles and commodity cycles. By carefully selecting infrastructure sectors, we intend to provide investors with exposure to strategic assets and diversification from a traditional core fixed income strategy. Additionally, by mixing structured products with more traditional fixed income assets, we aim to provide investors with additional collateralization of hard assets, which should add some resiliency in a more challenged macro environment. Now, let me look and address some of the questions in the queue. Let me gather. Okay. So there's a question, and it says, any issue or default due to COVID? Let me start by saying that we have never had a default in BuildX since inception, and we aim to keep it that way. There were, however, a few defaults in 2020 in the infrastructure space, and those were mostly high yield, and they were mostly high yield projects. No investment grade project as defaulted. But it's interesting because they were not due to COVID whatsoever. There were like a handful of projects that defaulted, and those were coal-fired projects. And if you remember, back in 2020, with on the back of fracking, the natural gas price were very, very low. And this pushed the wholesale market price to multi-year lows. And basically what happened is those projects, those coal projects, couldn't really compete and ended up going belly up. The other one I can think of, they were like in Argentina, and that were like, there's like a central bank moratorium. And those were high yield projects, but really nothing related to COVID in terms of default. Let me see other question. Okay, energy represents 11% of portfolio, but is one of the few outperforming sector of 2022. Are you comfortable with the allocation or seeking to increase energy exposures? Yes, actually, energy is 12% of the portfolio. We are quite comfortable with it. Especially that our exposure is mostly via midstream assets. So think about the pipeline. So they are pipeline with long-term contract in place with investment-grade counterparty, and we have very limited exposure to commodity price. So yes, we are comfortable with it. That being said, I think we can potentially see an uptick in exposure just because, I think there's more opportunity, as Andrew mentioned, like the buildup of LNG is quite interesting. Also, as I mentioned earlier, there's like some PDP securitization. Those are super interesting. Basically, like, pool of hydrocarbons that are being securitized, and you have kind of hedges in place, and you take advantage of that. Those are very interesting. So I wouldn't be surprised that we can see an uptick in there. Let me see if there's all right. Any strong view regarding the Fed meeting tomorrow? Well, it looks like the FOMC is set to hike by 75 basis points to fight inflation. So I don't think they're going to have any surprise here. But I will say that we have been pretty proactive in the way that we have managed Buildex, and we have positioned the fund accordingly. As I mentioned, we're exactly half the duration of the index. So we have been anticipating some wild inflation prints for a while. We're pretty short. So that should be that. But as far as strong views, no, it's just going to go. 75 is probably what it's going to go. What areas of opportunities are the most exciting in the infrastructure space? Well, thinking about exciting area, I will start by saying probably offshore winds. That is something that we haven't really been able to get into, but we are still looking for a good entry point to offshore wind. The other one that I think is super interesting is, we touched upon it, is the battery development, and to fight the intermittence of renewable. And I think this is being developed more and more, and we start seeing utility scale battery development. And I am, I'm looking forward to that. So I think that's super exciting. Also, data centers; those are super exciting. Obviously, digital, digital life is ever growing. So I think this is an ever growing space as well. PDP securitization, I talked about it, and also LNG facilities. I think I'm going to stop here as far as question. We're going to just conclude the webcast then. Thank you very much for your attendance, and thank you very much for your interest in the call and in the fund.